This video is going to discuss wedge patterns and how to trade them. A wedge pattern is simply low volatility pattern. You have the market moving up and down in a tighter and tighter range. And basically a wedge pattern looks very much like this. You can draw trend lines over the highs, you can draw trend lines underneath the lows, and basically you want to buy the breakout here when it breaks out over that level, and you want to sell when it breaks down underneath here. Preferably you use common sense. If the price is above the hourly moving average using our containment bands, and you see a pattern like this, you want to buy a breakout when the price breaks out over the highs of the wedge. If the price is underneath the hourly, you primarily want to look for sells. Also, looking at the statistical daily, weekly, and monthly trend, it helps when you buy or sell a breakout in the direction primarily of the weekly trend. If the weekly trend's up and price is above the hourly, then you want to buy. If weekly trend's down and price is underneath the hourly, you mainly want to sell. There's a lot of different patterns that you can see with this. The first is where either the high or the low is the same, and you have price come up, come down, come up, come down, come up, and this is oftentimes a sign of a reversal to the downside. Price is not able to make a higher high, and the lows keep making higher lows, and you can see price is getting sandwiched between this level, and you still want to take a breakout to the upside because clearly they're selling here, here, and here. If the price comes down and shoots up here, everyone who sold is losing money, and they're going to have to rush in and cover and buy, which causes the market to pop up. A lot of times these patterns signify a reversal. So even if the price is above the hourly, if you see something like this, specifically it's up near our upper containment band or any kind of resistance sell area, when you see this pattern and it breaks down, you definitely want to look to sell, even though it's above the hourly. You can ignore that rule for flat top or flat bottom patterns. Here's a flat bottom pattern. Price comes down to it, and you can see it's a wedge-shaped pattern where the volatility starts off at a decent amount and gets smaller and smaller and smaller. This is very similar to our NR pattern breakout, which, if you remember, is just a very sideways, narrow range, mostly rectangle type pattern that is very extreme low volatility. You may also see these type of patterns in rising or falling wedge patterns. Here's an example of a bullish falling wedge pattern. Price shoots up, comes down, and you can see the volatility is very small and it's getting tinier and tinier, but you have a wedge pattern here where, I didn't draw it perfectly, but you can see the volatility is shrinking, and usually these patterns are good continuation patterns. The trend was up, the market's volatility is getting smaller, it's not really falling too far off the high, and when it breaks out right here, you want to go long. On the flip side, if you have a trend down and then a rising wedge pattern, you want to look to go short. So you can see a rising wedge pattern like this, that once the price comes down and breaks down underneath this area here, you look to go short. Let's look at some real world patterns. Here you can clearly see the trend is up and the price comes down, and you kind of have a flat top wedge pattern, and when it breaks out right here, you want to go long. You can see this continued in the direction of the previous trend. Here you can see a trend that's down, and price kind of makes a reverse wedge pattern where the lows keep going up, and when the price breaks down underneath here, you want to go short. You can put your stop above here, and then you can see the price continues down another 40 to 50 pips. Here you can see the trend was up. We kind of have a flat top wedge right here. And when the price breaks out underneath there, you can see it falls down about 20 to 30 pips. The amount of movement once a wedge pattern breaks out is always hard to predict ahead of time. However, this pattern can lead to some directional trades, whether it gives you the opportunity to look for 5, 10, 15 pip moves or 30, 50, and 100 pip moves. All depends on the strength of the trend that day. Here's another one. You can see on this day the trend was up, the market pulled back, and you have like a little wedge pattern right here. You might have got in right here and put your stop underneath the low of the sideways range, and it took it about 20 minutes, and then the market shot up about 20 pips or so. Here's an example of one where you might have got into a losing trade. Price was trending up, as you can see, and it double topped right there, and you have a nice little wedge pattern here. You might have gone short right here, and then the price spiked up and stopped you out, and you might have even flipped and went long, and then price came right back down in the direction of the initial move, and you might have gone short again right here, and the price fell another 50 pips. Keep in mind, one of the keys to trading is to have small losses. Once price makes a 5 to 10 pip move, you want to cut your stop in half. Once it moves 10, 15 pips, you want to move your stop to break even. So in this first example here, where you might have gone short, your initial stop's above the high here. Once it moves down, 5, 6 pips, you might have cut your stop in half. Got out of that trade, you might have went long here. It went up 10 pips. That would have been enough to move your stop to break even. So you have two trades, one break even, one 5 pip loss, and then you wait for it to break underneath here just to be safe or safer going short again, and that trade worked. 1 out of 3 trades in this particular example, but break even and a small loss followed by the trade that worked. And that's really the key behind using this. Some of these patterns aren't the most beautiful. For example, you can clearly see a downtrend here, and the price reverses back up. Kind of have a flat top right here. You can see the volatility was decent here, and then it got kind of sideways, and you went short right here with your stop above here, and that trade worked. And then the price rallied back up, didn't break out this high, and you have clearly a wedge-shaped pattern forming as well, where the volatility gets smaller and smaller. Notice very volatile, less volatile, less volatile, and you should wait at least. These patterns have to take effect over, at the very minimum, a 30-minute period to a 3-hour plus period. Anything less, if you see one of these patterns that looks like it developed in 10 minutes, it doesn't count. These patterns work on pretty much all time frames. Here you can see a flat top where the price keeps hitting that level and bouncing off, and you can see underneath the lows keeps making higher lows, and then when it breaks out in the direction of the trend, you got this nice about 100 pip move. You can also see another one down here at the bottom where this is the high and the lows are gradually making higher lows, and when the price broke out right here, the market exploded up. So to recap, this pattern can be used to find continuations in the direction of the trend and also reversals. Oftentimes reversals have highs that can't get broken, where the lows keep going up, and when it breaks down right here, typically price reverses. The more times the trend line hits the low, the more likely the reversal is when it finally breaks through it. Same thing at the highs. This goes up, pulls back, goes up, pulls back, goes up, pulls back. Not in this case, for example, but if a high gets hit multiple times and then price finally breaks out, you have a lot of people going into the opposite direction. They're all losing money, and they have to rush in and buy to cover their losing trades. Their stops get hit, and that causes further upside price movement.